First thing I do is classical sampling, and I sent out a new classical sampling file. The one in Blackboard is an updated one. I sent out one last week that doesn't have the stuff we're going to cover today on it. It's a long story. There's things I took out of it a couple of years ago, and then I just decided to add it back in because I think it makes more sense. But regardless, so the new classical sampling handout that I sent out, that's the one that we'll be using. Fairly early on here, we're going to get a visit from the deans, Dean Murren and Dean Ryan. I'm not sure what they're going to talk about, so I guess we'll wait and see what they say. And then hopefully we'll finish up the chapter 1 and 2 handout. I think we should be able to do that. Not too much left. But so I think we'll start off tonight with a classical sampling. And so let's pull that up already. So it should look like this. And again, I just sent out a new one this week, and there's a new one in Blackboard. If you have one that looks like this, we need the other one. So it should look like this. Is there anyone that does not have that? Okay. Well, this is kind of going over sampling. And the whole idea of sampling is this, that you take a small sample of a large population, test on it, and then start trying to make a projection over the the population as a whole. So you take a small group and you say, okay, but for instance, if you have some kind of let's say you have some kind of a drug or something that, okay, it works on 40% of the people in our sample, so we project, maybe that we're going to 40% of the entire population. You do that, now we do that for a couple of reasons. First of all, taking something like, medicine, you can't take all 7 billion people on the planet and give them the medicine and see what happens. So you're forced into doing it. When it comes to auditing, we do it because it's much more efficient to do it that way, to take a sample rather than test everything. For example, you might be able to get at the 99% level by testing 5% of the items in the population. So you can become 99% sure of a value doing a fairly small, relatively small, I should say. So you may get 400 or 500 items, can give you a really good estimate of what the entire population is, even though the entire population may be 5,000 items. So it's more efficient. And like the human population problem, there are some things that would be impossible to do to audit 100%. If you wanted to audit 100% of the inventory of Walmart, it would be absolutely impossible to do that at, say, year end. Absolutely impossible. There's not enough auditors in the world to do that. And to audit all the stores, all the warehouses, all the trucks, all the things in transit, all the things on planes, all the things that are on boats and everything else, it would just be impossible. So there are some things that fall into that category of it's impossible to take the entire population. So you're forced to take a sample. And again, a lot of times in sampling, you can get fairly comfortable with the numbers by taking a fairly small amount of the total items. So that's what we're going to do today. And we're going to start out picking a sample, and we're going to do a random sample. Well, here, I'll stop talking and show it. That's a better way to do it. So here's our, these are all accounts receivable. Okay, and this is what the client has for accounts receivable. I didn't leave a space here at the bottom, but these all add up to 200,000. We'll see it on the next page. But we're going to take a sample of 5 items. And we're going to take the first 2 items of the random number table at the bottom. We'll talk about this in a second. Okay, we'll talk, and later on we'll talk about this more in depth, but you generally want to have a random sample because you want it to be unbiased. You guys, I don't know if you guys have had your statistics classes, but in statistics class, I'll say they want a random sample because they don't want to have any bias in it. It's the best. It's the best estimate of what the true value of the thing is. Okay, here is our random number table. It says that we're going to use the first 2 columns of the random number table to pick a sample. Okay, so the first 2 columns. Well, first of all, let's look at the random number table. And notice that if we were trying to match this up with the account numbers, it would be impossible. You know, if you were trying to use a random number table to figure out, you know, which one of these to pick using these numbers, it would be impossible to find, you know, this exact match in a random number table, or for any of them for that matter. So one of the things that, you know, a lot of times to make things easier, you say, okay, we have to, you know, kind of what sometimes they call massage the data. We got to get the data into some usable form that we can start to, you know, use to make, for instance, make a random selection of items. So sometimes it calls for pre-numbering the items. You know, instead of taking the you know, vendor account numbers or whatever they are, you can simply renumber them, and it's a little bit easier to pick the sample that way. Okay, we come to a random number table. And so this is what we're going to use. Notice that our sample has numbers 1 through 30. Right? So we have numbers 1 through 30, and we're going to go through and pick a sample of these items. 5, you know, 5 items we're going to pick using these first 2 digits of this table. So 03, is there a number 3? Yes, there is. I just did something wrong. Hold on. So number 3 is going to be the first one we pick. Is there a 46 on the table? No. Is there a 51? No. Is there a 32? No. Is there an 11? Yes. We do have an 11. Oops. So we pick number 3, number 11. Okay, so you guys get the idea. So why don't you guys tell me what items we're gonna pick in the sample next? We got 3 more to pick. What ones are we gonna pick?
14, 18, 28.
You would take 14, 18, and 28.
Correct, correct, and correct. Yep. So 14, well, there is a 14 in the sample, so we will take 14. There is an 18 in the sample, we will take an 18. There isn't a 91. There is a 28. And we would stop right there because we got our 5, right? 1, 2, 3, 4, 5. Okay. Now I'm just going to copy these down to the bottom here. So there's number 3. Number 11. 18. And 28. Okay, so we have picked our 5 items using a random number table. So it's a random number. Actually, they sometimes call this a random digits table because each digit is actually random, 0 through 9. But regardless, I mean, so you use it, and by the way, you can use different, you could say, okay, we're going to use rows 3 and 4. You pick different items, but it'll be a random selection, or you may pick different items, or whatever. You could, there's other ones, you could use almost any column that has 2 digits. You could use those 2. So now here's why this is, here's why they still do use these. And sometimes they'll have computers that generate them also. But here's the one thing about auditing that's a little strange, and that is everything that you do in auditing must be able to be replicated by somebody else and get the same result. So someone else has to come in, pick a random sample and come up. Now notice, if everyone picked their own random sample, it's not going to be the same. They're not going to pick the same item. So this way, if you have it, you have it written on your table that you're in your program that you take the first 2, everybody's going to use the first 2 columns. They're going to pick the exact same random sample. It's still a random sample. They're just going to pick the same random sample, do the testing, and come up with the same thing. Now, the results of the testing, maybe I'm just making this up, maybe like 5, let's say they're 5% error. Everyone should come up with that same 5% error, right? I mean, whether that's material or not, whether you're going to make a big deal out of it or not, that's a judgment call, and that could be different. But the actual result of the testing should be exactly the same for everybody. They should be able to be replicated with the same result. The judgment may not be replicated just because it's judgment. And but the actual results of the sampling should be the same. So here's what we're going to do. We're going to find first thing we're going to do is find the total, and then we'll find the average for each of these 5 items. So let's find the total of these items. All right, Mr. Calculator, and time to use the Mr. Calculator webcam. All right. And so here we go. You may want to check me on this 7607. Six 1887. 33,795. And we're gonna do the same thing for the audit side. $32,395. Okay, I'm gonna check and make sure I got these right. By the way, another funny thing about auditing is I was just showing what a calculator looked like in case you guys are wondering. One of the funny things about auditing too, though, is you say, well, you know, wouldn't this be easier just doing an Excel spreadsheet? Yeah, you probably would. However, and I know that they still do this, a lot of CPA will still do that. They'll a lot of times will add them up manually and make sure that the numbers at the bottom are correct. They do not want to have a problem with the audit because of an error, you know, an Excel function, function error, you know, that they did something wrong with the Excel and summing it up or whatever. So a lot of times they will actually do it by hand again, and they'll have tape that come on. I know people think it's like hilarious, but you know, you got to check your numbers. And so a lot of times you'll see people do it by hand. They'll actually have their little printer calculators and that and do it by hand. Okay, now we're gonna need to find the average for these. So how would we find the average?
Divide the total by the number, like
Yep.
the number of them.
Divide by 5. Oops. Oh, hey.
Hi.
17.
Did you just say, oh my goodness, there's a Zoom bomber crashing my class?
Here, let me get out of this. Yeah, so are we waiting for Dean Ryan?
No, I think it'll be just me tonight.
Okay.
Yeah. Would you like me to share my message? I didn't know if you were mid-sentence or mid-example. I can certainly wait.
No, they would appreciate if somebody else would talk, right? So-
20 minutes in too, huh? Well, hello, everyone. My name is Jennifer Murrin, and I serve as the Associate Dean for the Heller College of Business, and I also teach in the HR program here. And I am clearly very comfortable joking around with your professor here. I used to sit next to him and had worked with him for about 20 years now, which is not part of my welcome or anything to you. But I guess it might be part of my welcome, because really my point of visiting your class and visiting other classes this week is to say, welcome to the spring term. We know that you have a lot of choices. We also know that there's a lot of uncertainty and a lot of things going on right now. So we just want to really remind you to use resources that you have at your disposal. And some of those resources are people. Your professor, Mark Taylor, myself. I'm going to actually put in the chat now my email address, the email address to the dean, and then a third email address. I know that this is a graduate accounting course, so this may or may not make sense for this group, but for any undergrad or graduate student that is seeking tutoring services in a particular area, and accounting, finance, and stats tend to be those areas, anyone can email a request to hcbtutoring@roosevelt.edu. I do know this is a graduate accounting class, so that may or may not make sense with this group, but perhaps there is another class. You know, we're not specialists in everything. Actually, the great irony I think in life is that in my business program, accounting was the most challenging area for me. And then fast forward, you know, I have multiple bosses with accounting backgrounds and I work heavily with accounting faculty. And so can't get away from it. Just embrace it. I'm going to pass along the advice someone gave me. Just embrace it. Embrace all of what accounting brings. So welcome to this term. Use all resources that are out there. You know, Mark Taylor will go to the ends of the earth to find somebody to help you out if you have an issue, academic or not. I will do the same thing. So, you know, copy and paste or in some way kind of mark those emails for at any point in the future. If you have a question on something, you're looking for something, feel free to you know, in addition to going to your professor, whether it's an academic or non-academic issue, feel free to come to me, feel free to come to the dean. We really do, you know, we kind of, as goofy as this sounds, I really think of it as team you, Mark Taylor, myself, Mariah, we're all on your team. Mark, myself, David, we're on your team. Mark, myself, Courtney, we're on your team. Mark, myself, Victor, we're on your team. And no, I would not do that if we had 35 people in the class. But we are on your team. And that's why we do what we do. So I work to hone my mind reading abilities, but I don't get very far. So I just rely on you to communicate what you need. And then we kind of go from there. So thank you. Welcome and have a great class tonight. Was that a fantastic 3 to 4 minute break? I promised I'd limit my time in here and I have adhered to that.
I will send out the emails from the chat to the class. So
Okay,
yeah,
sounds good.
Yeah. So they'll have it
For other class members.
I'll put it in Blackboard too.
Perfect, absolutely perfect. Our emails are not secret. They can be published everywhere and anywhere. And we do respond to all student requests. So yeah, and you've probably also, for students in here, you've probably also already gotten some communication from the dean or I when we have internship opportunities, job opportunities. You know, we're trying to centralize all that through Handshake, but we find out about it and then we separately also email you. So that, you know, face behind the emails, and of course, you know, reach out at any point in the future. It doesn't have to be in this term. So yeah. All right. Well, have a great class. Thank you for letting me stop by.
Thank you so much.
Thanks. Bye, everyone.
Bye. Thank you.
Thanks. There really are people there. I love it. Okay. Bye.
All right, let's go back to. Okay, so I didn't do this. So we have, so this would be our the audit average would be 64. And the book average I did something stupid here. Divided by 67.59. Okay, so these are the averages. Okay, so the book average is this. Oh, that looks funny. I'll fix it later. And then this is the audit average. Okay. It's a little too big. So our audit average is this. And book average, I'll make it yellow. How about? I gotta ask you a question here, just in general. Which one is, if you're an auditor, which one is probably more reliable? The one that you did yourself or the one you got from somebody else? Which one would be more persuasive to you? Would be more, would you be able to rely on more? The one you did yourself or the one you got from somebody else?
You did yourself.
Yeah, this is the better number. This we know that we know we went back and looked through the invoices or whatever we did, and we came up with this number. This is the more better number than getting it, say, secondhand from somebody else. This is the one that we came up with. So this is a more convincing number, the audit average. So this is the one that we're going to use. This is kind of, to a large extent, kind of running this thing, how we're, what we're going to do with it. Now, I'm going to copy this down here. Okay, so once we get the averages, now, so we get the, we did our testing, we got the average of each of the audit in the book, and now we're going to take that and we're going to project it over the entire population. Now, the entire population is, this 200,000. This that's how much the accounts receivables are. The book value of the accounts receivable is 200,000. So we're going to try to see if, whether that is high, low, or whatever it is, this 200,000. So this is a, how do we take these two numbers and project those over the entire 200,000? Okay. And there's actually three ways we're going to do it. Mean per unit, ratio, and on the following page, difference estimation. Okay, mean per unit. Mean per unit is this. We get our audit average. And we say everything, we get this average, everything in all of these 30 accounts should be at our audit average. We came up with an average of 6,479. All 30 accounts should be 6,479. So we're going to multiply it by 30, and this will give us our projected value. Document cam. Okay, so 6479 30 equals 194 370. Yeah, sorry. So this is what we project is the true value of the accounts receivable, not 200,000, but 194,370. Did you guys get the same number, by the way? Right.
Yes.
Oh, you did. Okay, good. Okay, so here's the question. The question is, well, what is the projected misstatement? Okay, we had a book value of 200,000. Projected value of 194,370. So the misstatement would be the question is how much is this thing off by? 5630. So this would be a projected misstatement. Yeah, I think that's right. Okay, so we're saying that the books are misstated by 5630. Now, they have 200,000 on the books. We're saying that it should be 194,370. So this is where it gets to be a little bit tricky in that are there the 200,000? You know, we're saying it should be 194, whatever, 370. Are their books overstated or understated? The book value of 200,000.
Their books are overstated.
Correct. Yep. This is an overstatement. They overstated their books by this. So these are overstated. Now, you know, in auditing terms, you say, well, okay, is that material or not? That's a judgment call, you know, whether that's material or not. What isn't a judgment call, though, is how much you came up, how much it's overstated by. So, you know, but as far as like if it's material or not, again, you know, that's a judgment call that you have to make it. If you're on the audit, you have to make that call. But this is what they would be overstated by. And by the way, especially when you're starting out in auditing, you don't make those judgment calls, to be honest with you. You know, you'll give it to the senior. The senior will probably make that call, and the senior will probably contact the audit manager and check to make sure that they're on the same page with it and all that kind of stuff. But it's a judgment thing. So after you work a couple years in, you'll have that judgment whether that's material or not. Okay. Second way we do this is through ratio estimation. And ratio estimation says that things are off by a ratio is to the size of the item. So for instance, if you had an account that was $50 versus an account that's $50,000. Okay, account that's $50,000, you say, okay, is it likely that it could be off by $200? Yeah, I mean, there's a lot of stuff in there probably. Yeah, it probably could be off by a couple $100. That wouldn't be that unusual. A $50 account, it'd be kind of unusual to be off by $200, right? I mean, that's a pretty, that's several times the correct amount. So the ratio method says, okay, big accounts will have big errors and small accounts will have smaller errors. You're not going to get a $50,000 error in a $200 account. It just isn't the way things usually go. So the ratio estimation says, again, that it is relative to the size. The errors that you'll find will be relative to the size of the account, whatever item you're testing. And they say, okay, well, there must be a ratio then of this audit to the book amounts. So we're going to take the audit. Here. And the book. And we're going to say, look, there's a ratio here. Let me see what the ratio is. So 6,479. 6,759. So about 0.958 something. This is saying that okay, here's the ratio of what these are off by. So if you have something that's off by $50, you can multiply by that ratio, and that would be, approximately what it'd be off by. If you had something that was 600,000, it'd be, well, I guess you couldn't have that in this situation because it only goes up to 200,000. But if you had something for 50,000, you could multiply it and it would be the same thing. So what we're gonna do is multiply the entire book value by this ratio and say, look, these are all off by this percentage. They'll be all off by the same percentage. So we're gonna multiply by the entire book value. Say, okay, everything in that will be off by the same amount. So we're gonna multiply this times 200,000. Uh, 19175. Is that what you guys got or no? Wait. 191,715. I'm sorry, I missed a one here.
That's what I got.
Yeah, okay, good. So, and again, this one is saying, look, everything is off by a ratio, and that ratio is whether it's off by, whether it's a $50 one or $50,000 item, that they're going to be off by the same ratio. Big things have big errors, small things have small errors. Corrected misstatement would be 8285. Overstated or understated?
Overstated.
Yeah, we're saying that they should have 171 in the books, and they have 200,000. So it says something wrong. 191,715 on the books, and they have 200. So they have, this is overstated. They're overstating it by 8,000. And by the way, that's one of the things that the CPA exam a lot of times will have. Is a, that's not me. It's my calculator. One of the things the CPA exam will have is they'll say, is this are they estimated to be overstated or understated? How much is a misstatement, that kind of thing. But they really get into whether it's overstated or understated. It's one of the common things that they would ask, either in a problem or in a multiple choice scenario. Okay, so this is ratio estimation, and it says that big things, big errors, small things, small errors. They're spacing on this funny. Okay, difference estimation is sort of just the opposite of ratio, not completely opposite, but it says if something is misstated, it'll be misstated by the same amount. So a $50 item will be misstated by the same amount as a $50,000 item. And usually it's because of some quirk in whatever it is you're looking at. For instance, suppose that there's a handling charge that's supposed to be added to certain orders, $10 or whatever. And it doesn't matter whether it's a $50 order or a $50,000 order. If that's what is likely to be, that's likely to be the error, that people forget to put the handling charge in, and the handling charge is a fixed amount. It's likely, it is at least that some of these are going to be off by exactly the same amount. That they're not going to have this handling charge entered, or maybe they have the handling charge entered when they shouldn't have it entered. you know, it could go the other way too. And that, you know, that this is something that is being charged for a handling of whatever, and it shouldn't be charged that. So, you know, when you have these fixed amounts that it's possible that they're off by, that's when this difference estimation comes into play. That this would be, you know, the kind of idea that you'd have is that it doesn't matter whether it's a $50 order or $50,000 order, they're likely to be off by the same amount. Okay, so we start out with, this looks funny. All right, I'm not sure what I did here, but we need the audit amount minus the book amount. Oops. The spacing on these is funny. Not sure what I did there. By the way, when you're looking at the ratio and the difference estimation, it's all, the audit clause comes first and then the book comes second. And just think about it, it's alphabetical. Yeah, I'll tell you something strange. In a lot of accounting, you know, we do ratios in accounting for other things like percentage of production and all this kind of stuff. It's really weird that almost all of them are alphabetical. I know I always wanted to like write a paper about how it's always alphabetical. You know, whenever you do ratios on anything, whether it's accounting, auditing, or whatever, it's almost always alphabetical. That, you know, you go in alphabetical order, you'll get the right ratio or whatever. But again, audit minus book. Okay, so what we're saying is that for each one of these, they have to take off. There's differences here. Okay, so this comes out to be negative 280. So here's what they're saying, is that each item in the total population should have $280 taken off of it. Okay, so times 30. Projected misstatement. 8,400. Anything about it is negative here. This is that, you know, this is how much they should take off of there basically. So the projected misstatement, we're not going to put a negative in there. It's actually going to be just a misstatement, and we'll see whether it's overstated or understated. Notice something about this method that's different than the other ones. What do you notice right away that's different when we're calculating the misstatement and the projected value? On the other ones, we did the projected value first, right? On this one, we do the projected misstatement. We're saying, okay, everything is misstated by 280. You know, so you have to take off 280 off of each one of these things to get to the right number. Okay, so total book value is, are we saying these things are overstated or understated? Are the book amounts too high or too low? So we're saying they need to take off 280 for
It should
each.
be it was understated.
Actually, it's overstated. We're saying that they have to take off the 280. You know, it's kind of a funny way to look at it, but yeah. So that these are, we're saying that they need to take off 8,400 off of their book value. So this projected misstatement of 8,400. This is 200,000. So we're saying they have to take off 8,400 off of the 200,000, so whatever that is. So we got to kind of back into the one. So this projected value, we got to kind of, and this one is probably the more confusing of all of them. And I gotta imagine this is probably the least used of them because it's such a narrow, usually use of it. But again, this one is for those things that are generally off by the same amounts. You know, it doesn't matter what size it is, whether it's a big item or a small item, that they're all going to be off by 280. Any question on that? So we're saying that each one of these items, you need to take 280 off of each item, and there's 30 items total. So you're gonna take off a total of 8,400 off of the 200,000. So these all came out that they're overstated. And by the way, this is one of those things that a lot of times can be overstated, and that these are accounts receivable. And one of the things you always look for is, are they putting fake sales on the books? You know, are they putting sales on the books that really don't exist? They either do it through adding a little bit to all the accounts, or they could put a completely fictitious one in there. But anyway, yeah, so you know, this is one of those things that a lot of times you look for to see if it's overstated, because if they overstate accounts receivable, they also overstate sales usually. So those are three methods, and we're going to do more on that. Obviously, we're going to go through the quarter or semester, I should say. And so for each one of these, though, we took this. You know, they all use the same. Oh, I didn't copy it down. They all use these same numbers, the audit and the book values. Okay, this is, I should have corrected this. I'm missing a word here. All three classical sampling methods will estimate the projected the same projected value. Add that in. The way it's written, it's true. They will all give you a projected value, so that part is true. But will they give you the same projected value? No, right? Those two are pretty close. The 191, 715, 191, 600. Those are pretty close, but they're a little different. And then this, you know, so they will not give you the same amount. So I'm gonna see false here. It is true though that each method will give it the same. Will give a projected value. This won't be the same. And I get to add that in. I realized that earlier. But I already sent out the stuff. Okay, I'm gonna stop right there. Okay, what we'll do, let's go ahead and take a break and come back at, say, 7. And then we'll start on Well, hopefully we can finish the chapter 1 and 2 handout. Oops. Okay. All right. Straighten out my dog. So I think we finished chapter 1, but stop here after partner 1. So chapter 2, we're going to that. Hopefully we'll finish this today. We'll see. But let's start out just kind of an overview. We already talked about this a little bit in chapter 1, but let's kind of go over the breakup of who runs what. Okay, the American Institute of Certified Public Accountants, they make rules for who?
Issuers.
Yeah, actually both of these. They make them for private. Yeah, okay. And for public too. So the AICPA, they make rules for everybody, basically. Are they a government agency?
No.
No, this is a club. They issue or revoke CPA licenses.
No.
Nope. They register CPA firms. Nope. Create the CPA exam.
Yes.
Yes. So they make the CPA exam. They are not a government agency. They have no direct power. We'll talk a little bit about in a minute or two here about some powers they do have, basically. They don't make CPA, they don't create issue CPA licenses, they can't revoke them, they don't register CPA firms. So that's kind of where they're at. Okay, state laws. States make laws for
Both.
Yep. Private, they make laws for you. If you're public, they make laws for you. If you're registered, if you have a corporation that is chartered in a state, whatever state rules are, they have to follow whether they're public or private. Is a government agency?
Yes.
Yeah.
Issues or revokes CPA licenses.
Yes.
Registered CPA firms for issuers.
Yes.
Actually, it's no. Now, they will, to be a registered CPA firm, you do have to have a license in the state. They have to be licensed, but the actual registration is going to be done down here on the PCOB. Creates a CPA exam.
No.
Nope. They could, but they don't. PCAOB, this is the underneath the Securities and Exchange Commission. They make laws for
Issuers.
good. Only issuers. If you're not an issuer, they have no jurisdiction over you. So IBM, they have to follow the rules. Joe's hot dog stand does not. Is a government agency?
Yes.
Issues and revoke CPA licenses.
No.
No.
Nope. Only states. Register CPA firms.
Yes.
Creates a CPA exam.
Nope.
Nope. What do I do here? Now, there is something a little about the PCAOB that makes the AICPA a little bit more significant. And this goes for both. This goes for both the accounting rules and for the auditing rules. And that is that the PCAOB requires registered CPA firms to be members of the AICPA. So think about it for a minute. If you're required to be a member and that membership has rules, you're pretty much required to follow the rules of the AICPA if you're publicly, if you're auditing publicly traded companies. So you don't want to get kicked out of the AICPA, because if you get kicked out of the AICPA, then you're not going to be a registered company with the PCAOB. So even though AICPA is not a government agency, it's just a club. It's a club that you really don't want to get, on the bad side of, because the PCAOB requires companies to be members of the AICPA. So, again, the AICPA has no direct power, but through other groups they do. Okay.
Does the PCAOB ever like tell the AICPA like what rules to make, or do they just make their own rules and it's because it's a government agency you have to follow it anyway? But like if they're requiring you to be a part of the AICPA, it seems like
Yeah.
they would have more say in what they do, even though it is just a club. But I don't know.
They certainly do, and a lot of most of the PCAOB rules, many of them anyways, come directly out of the AICPA. Some of them don't, and basically, I'm sure that there's communication back and forth between them as far as what what they're going to do and all that kind of stuff. But the one thing you gotta remember too about the PCAOB is they're looking at very large companies. I'll give you a stark example. If you do the financial audit of a non-issuer, right, a privately held company, you just do an audit on the financial statements. That's it. Right? You do an audit on the financial statements, say whether they're materially misstated or not, and you're done. If it's done through the PCAOB, you're required to do an audit on their financial statements. They're also required to get an audit on their internal controls. So they actually have two audits. They'll actually have two audits. One for financial statements and the second one for the internal controls. They're required to have those. So there's a difference there between the PCAOB and the AICPA. Now, when it comes to which rules do you follow, generally you're going to have to follow the stricter ones. You have to follow both of them as best you can, but the federal government rules are going to take over. A company can't say, well, the AICPA doesn't require us to do this. They say, well, it doesn't matter, we do. So yeah, they're kind of parallel. A lot of them match exactly. They're they're the same thing, but they are a little bit different as far as what what they're required in that. So which is in some ways is good, and in some ways makes things a little bit more difficult, because it's easier to have a third party like the AICPA make the rules and then tell companies they have to follow them than it is for the government agency, which can be political and all the kind of other stuff that goes on in there. Sometimes can be a little bit more tricky, but I have to say that the PCAOB has generally been, I think, very much independent and very much, their rulemaking is generally more strict than the AICPA. And again, a lot of times it's because of bigger companies, that they're dealing with. So there is kind of what they would term a large company, small company kind of audits. That not publicly traded ones, they have different rules because they're not as big than the big ones. So yeah, they do make rules though, separate of each other. And again, kind of for the two reasons we just talked about, that they have, they're only for publicly traded companies, which are bigger, more complex, have more rules, and that it is a direct overseeing of the rules, rather than saying, oh, by the way, you have to follow this other group's rules. So yeah, people were very nervous about that though when it came out, that like, oh great, now it's going to be political. You're going to have, you can imagine what our politics are like. That oh great, that's going to be part of our audits now, or are we going to have this this kind of nutty stuff going on? But okay. So yeah, so these are the the groups that make the rules, and again, they're not all the same, but the ACCPA makes their rules. Not a government agency. Government agencies will make the rules. States and publicly traded company oversight people will. They're usually very much in agreement on the stuff. Okay, misstatements. I think we already talked about this. What kind of misstatements do we look for? We only look for misstatements that are
Material.
So we're looking for misstatements that are material. Characteristic of an error. This is somewhat important. Errors are usually unintentional. And they do happen sometimes. About 10 years ago, General Motors, they're having a terrible year anyways, but they made a few mistakes on their statement of cash flows, and almost humorously, there was actually accounting classes, a graduate accounting class that found some of the rules that alerted them to say, well, wait a minute, you got this in the wrong spot. And sure enough, big embarrassment for not only General Motors, but also for their auditors. Their auditors didn't catch it. But they, like I say, it wasn't like they're trying to make themselves look better. They were having, they lost billions that year anyways, but it was an error. Okay, what do you think is the characteristic of a fraud? So characteristic of an error is unintentional. Fraud, it must be what?
Intentional.
Intentional. And this is why fraud is hard to prove. It can't be, oh gee, someone made an error. It has to be some intention. You have to show some type of intent. And usually the intent is shown in some way of trying to hide it. That's a usual, like a common way of doing it, is that, it's showing that they actually made an attempt to cover it up or to somehow mislead people that it was what they were doing. There was a kind of famous case about this, and that is that there's it was a little bit complex. A guy bought some shares in a company that was going to be merged, but it was a privately held company, and so he bought these shares of this, that was going to be basically become a privately held company. There wasn't going to be anything with the public, so there couldn't be any insider trading because there weren't going to be any public trading. There's not going to be any public trading at all. So there is no insiders getting that. They're all insiders basically. Well, lo and behold, when the actual merger came through, they decided that it was going to be a public offering. And they were saying, well, they tried to bring it in on the sort of intent, saying that, oh, this is a fraud, this was insider trading, and that there was an intent to do it. And that it basically got thrown out because there was no intent, that the intent was not to defraud. And I mean, and the guy, he paid back all the profits and all that kind of stuff anyways, but it's kind of a strange case. Okay, type 1 fraud. This is fraudulent financial statements. So this, when there is a material misstatement, appears on the financial statements. Type 2 fraud is a misappropriation of assets. Commonly known as employee theft. Oops, that's of. So misappropriation of assets. Who did that? commonly called employee theft. I just like that term, misappropriation of assets. It sounds like something you should do or something, but it's actually employee theft. Which one of those two are we more concerned about, do you think? Fraudulent financial statements or employee stealing?
Fraudulent financial statements.
Yep. So this is usually the focus of the audits are usually on this, and especially if you're talking about larger companies, it would be very unusual to have a fraud that would distort the financial statements. You've got companies that have 5 billion in income. It would take an awful lot of fraud to have that actually change that. $5 million is nothing. So, it'd be very difficult to have. Okay. Compliance with laws, illegal acts, direct effects are more important to auditors. Example. Tax evasion. So notice if a company is doing tax evasion, is committing tax evasion, have a tax problem, that's also going to show on their financial statements, right? Their tax expense will be too low, and it'll show their income being too high, and it has a direct effect on it, right? So if they're cheating on their taxes, there's a direct impact on the financial statement. So we're more concerned with that than the indirect ones, which we'll talk about next. So those that are direct are more important. You imagine these are less important to auditors. One minute. So EPA violations. Now, EPA violations are bad, the environment, all that kind of stuff, but there usually isn't a direct impact. They could be fined in that they could be told to clean it up or whatever they did, but it's not going to be that direct one-to-one that you're going to get with a tax violation. So a tax violation is going to be more important to us because it's direct. EPA, they might have some liability hanging out there depending on what the EPA what they want, what they do. They fine them or tell them to clean it up or whatever it is. There might be some liability out there, but it's not usually direct. And then you don't even know what it is. It may even be nothing. Sometimes they tell them to knock it off and they say okay, and it really just depends. Okay, responsibility for detecting illegal acts is the same as anything else. Oops. And again, this whole thing about material comes into play. It must be material, or else it's not. We don't worry about it. Okay, responsibility for illegal acts, for reporting. Okay, so you know, what happens when you find an illegal act? You know, what do you do? What do you do if you find an illegal act? What do you do with it? Well, you report it up to management. I'll put, let me put it in here. Let's write it in rather than me say it. So we'll call this step 1. 1 second here. All right, so step 1 is report to upper management and the audit committee or board of directors. Okay, so go to upper management and the audit committee or board of directors. If they don't have an audit committee, you go right to the board of directors, for instance, privately held. Now, the question becomes, well, what if management doesn't do anything with it? So you report, okay, here's an illegal act, report to management, and they don't make an appropriate decision. They don't make a decision that you're comfortable with, you know, whatever it is. What do you do? So what do? You report it to them and they don't do anything with it. Now, notice you're in a tight spot because you have this fiduciary duty to this client. The stuff they're showing you is confidential. You know, all the information is confidential. It's stuff inside the company, and that you're looking at their books and their financial information and other stuff. So it isn't like you can just go tell that to anybody. You know, the question is, do you run to the police department or the FBI or whatever? And generally, no, you don't. So we'll see what happens when you do run into this, that you report the illegal act to upper management and the board of directors or audit committee, and they don't do anything. Or their react, what they do is not enough. It's not adequate. Okay. Oops. Sorry about that. It's more inadequate. Then, okay, it makes a difference if it is publicly traded or not. Okay, so step 2, we'll call this. And that is if it's a non-issuer. This is going to sound like a complete cop-out, but you got to get a lawyer. So if it's a non-issuer, if it's a non-issuer, it's a little bit more difficult because you generally have to get a lawyer. And I know it sounds like a complete cop-out, but you're in a tough situation because it's a fiduciary duty, but you also are a licensed professional, like a doctor, you know, that kind of stuff. So you also have a duty to the public. You know, and notice that those two are conflicted. You know, there's this illegal act that, you know, is harmful to the public, which you have a duty to, but you also have a duty to the client. So, you know, you don't have to get a lawyer. Now, if it's an issuer, it's a little.
What is an issue? What is an issuer and a non-issuer?
Oh, issuer, a non-issuer is a privately held company. In other words, you can't buy the stock in it. Like a local cafe probably would be a, you know, a privately held. Whereas an issuer is publicly traded, you can buy the stock. Okay, so step 2. Two, if it's an issuer, this is publicly traded. IBM, Apple, etc. So if it's publicly traded, the owner must contact the Securities and Exchange Commission within 24 hours. Now, keyword there is must. If you don't report it in 24 hours, you're going to be in trouble too. It's not just going to be the your client. So the auditor must contact the Securities and Exchange Commission within 24 hours. So if the response that comes back is inadequate, non-issuer, you get a lawyer. Issuer, you contact the Securities and Exchange Commission within 24 hours. And for the issuer at that point, I mean, if you're client, it's in the SEC's hand, and it's outside of your hands completely. And by the way, you may be wondering, well, why do they do that? They do that so that companies will act appropriately. Because the auditor will say, "Oh, look, my hands are tied. I have to contact the Securities and Exchange Commission within 24 hours, or else I'm going to be in trouble." So, it would be in your best interest if you take this seriously and do something about it. And that's really what it is. It's kind of like, look, would you rather deal with the auditors, or would you rather deal with the SEC that can fine you, stop your trading, do all kinds of stuff, mean stuff to you? It'd probably be better off just to, and in the end, you're going to have to, act appropriately anyways. So, the whole idea is that if you get people to get management to actually do something. So you give them.
Could you also get a lawyer in the second case just to cover your butt, or is it really like the
Probably.
SEC is going to be totally fine?
Probably, but it is a more streamlined process in that it is a requirement of you that you have to do this. You probably would get a lawyer. I mean, I would imagine you talk with legal people before you did this, and certainly you'd go all the way up into the CPA firm. But if you had somebody though that was doing something and you didn't feel like they were dealing with it appropriately, you are required to do it within 24 hours. And again, if you don't do it in 24 hours, you're going to be in trouble too. So, and the whole point of it is to try to get management to realize, look, you can either deal with it appropriately now, or you can do it with a bunch of regulators coming in and dealing with it that way. So, I imagine that there are some negotiations when these things come about, but at some point, the whole idea is to get companies to take illegal acts seriously. Okay. Types of audit reports. I'm going to go to the next page. Okay, so you know, again, the illegal acts are generally, they must be material. You know, for example, if you have somebody, you know, let's say that let's say the controller double parks illegally every day in the alley, every single day. Is it material? Probably not. Being a jerk, but you know, so you're only looking for those things that are material, and you don't look at, you know, everything. Just, you know, the dollar amounts and what it actually is do make a difference, but only those things that are material, only those things that would affect the financial statements and people's decision when it comes to investing in a company. Okay. Types of audit reports. The first one is what we call a clean opinion. Let me say, let me give you the real terms for it. Unmodified. This is for privately held non-issuers. And by the way, the term non-issuers and issuers comes about because of it is a kind of a weird term. I've only ever seen it in auditing, ACCT auditing circles used, but issuers are required to issue financial statements, non-issued by the Securities Exchange Commission. Non-issuers are not required. So privately held companies are not required. Issuers are required. So it kind of goes by the jurisdiction of the SEC. Issuers are by the SEC. Oops. This is for issuers. This is what they call a clean opinion. Sometimes called a standard report also. Unmodified, unqualified. So also known as clean opinion, standard report. Allergies are kicking up. So clean opinion, standard report. So these are the official terms. Now, unmodified opinion means that there's nothing wrong. You don't have to modify it in a certain way. Unqualified sounds kind of funny a little bit. And I think that's what they used to all be called unqualified, but now they call it unmodified. And when you unqualified, when you think about unqualified, you say, well, that sounds bad. Just someone's like unqualified. Or what they mean is there's no qualifiers. There's nothing to say, oh, these financial statements are okay, except for, and then they go into qualifiers. You know, all these are, you know, they're unqualified in that these are exactly what they say they are. I'm not going to add anything else onto it. These are what they, you know. So unqualified, while it sounds bad, is actually good. So the uns are good. That's what people want. Unmodified, unqualified. That's the, you know, the type of opinion you want. So it's called a clean opinion or standard report, same thing. Okay. Well, the next one are modified, qualified report. This is for non-issuers. Oops. And just a qualified opinion for issuers. This is when there is a material misstatement. But it is non non-pervasive. Usually only one account. Excuse me. I apologize, my nose has started running for some reason. Okay, so a material misstatement. So this is when a material misstatement is, that is on the books. Non-pervasive means that it's not throughout the entire financial statements. Usually only one account has this problem. This is often called an except for opinion. You say, why? Because you say everything is fine except for, and then you go into the bad stuff. Whatever it is. So these are often called except for opinions. In fact, you probably hear it called except for opinions more than what they really are, which is qualified. So it's a qualification on the report. It's saying, okay, everything here is fine. Here comes a qualification, except for accounts receivable. Accounts receivable are on the books at this amount, or we couldn't verify this amount of the accounts receivable, whatever it is. So an except for is there's a material misstatement. However, it's isolated. For instance, maybe we couldn't verify the inventory in some other an unstable country or something like that that has inventory that you can't get to. And okay, well, except for this, everything is okay. So what I tell you, well, okay, you can rely on the sales, you can rely on the cost of goods sold, you can rely on the selling expenses, you can rely on, all the other stuff you can rely on. It's just this one account, whatever it is, that it has a problem. So a qualified opinion is one of those accounts that has is one of those things that only have one account has a problem usually. Okay, the worst opinion is an adverse opinion. Oops, modified. And opinion. Second. Oh man. Okay, here we go. Non-issuers adverse. Final adverse opinion for issuers. If I put these are opinions. Hey. And yeah, so and these are adverse opinions. The adverse opinions are the worst. Usually they have multiple material misstatements. They are pervasive throughout the entire multiple accounts. They are not GAAP, not generally accepted accounting principles. Not fairly represented. So these are the worst types of opinions. So adverse opinions are, hey, you can't rely on these, period. You know, they're misleading. They're not fairly represented. They're not GAAP. They cannot be relied upon. And it's more than just one account. It goes through, you know, so you can't rely on the sales, you can't rely on the, you know, the assets, you can't rely on the liabilities that they have listed, you know, it's throughout the entire financial statements generally. So an adverse opinion is that it's more than one account and that the financial statements are not what they appear to be. They cannot be relied upon. So that's a worse opinion. So if there is a problem, generally these two. Now for these two, there is a known misstatement. Whatever it is. So for a qualified or adverse opinion, the dollar amount is actually known. And you're going to put it right in the report. Hey, these accounts receivable are off by $500,000 or $1 million or what, you know, and whatever accounts are off, you're putting them right in the report. In other words, there's no getting around it. That report's going to go with the financial statements. Whoever's reading those financial statements will read the audit report and say, well, wait a minute. You know, these are all wrong. These numbers are all wrong. You know, and so the whole point of that is to kind of get management to see the light saying, look, you got to change your financial statements because this is the report that's going to go with it. And you know, you say you don't want to make the changes for these accounts. Well, guess what? That's going to be in the audit report. Everybody's going to know about it. And they're also going to know that you tried to put out fraudulent financial statements. So the dollar amounts are known for both the qualified and the adverse opinions, right? You know what they're off by, and you're going to put them right in the report. That, you know, this account is misstated by this amount. Okay. Now, there is a fourth type of opinion that is really not an opinion at all. of opinion and opinion. Okay, a disclaimer of opinion. This is when if there's not enough evidence available for an auditor to make an opinion. So auditor, we try to get evidence back up. Well, like we just did the sampling thing. That's evidence, right? You have evidence of this accounts being off or whatever. If you can't get the evidence, why can't you get it? Well, it could be, maybe they had let's say they had a theft. Someone came in and stole all the accounting computers, in the company. Okay, well, you have backups, right? Yeah, where are the backups? Well, they're in the safe. Well, they took the safe too, So you could run into those situations where you just can't get the information. It isn't there. Maybe they had a fire, maybe they had a flood or something like that. The information just isn't there. You can't get enough evidence to form an opinion. Then you have a disclaimer of opinion. A disclaimer of opinion is like nothing. It's like saying, look, here is nothing. And here's our bill. So generally speaking, they don't want to get disclaimers either. But a disclaimer is when you cannot get enough evidence. It could be because the client refuses to give you evidence. For instance, one of the things we have to do, US standards require that we talk to lawyers. Do we have to talk to the lawyer of whatever the company is? They talk to their legal counsel. So you have a client who, well, you're not talking to my lawyer. Well, we have to. Well, you're not talking to him. Okay, well, and by the way, when somebody tells you you're not talking to my lawyer, who's the first person you want to talk to? You want to talk to the lawyer now, because you're probably mildly interested in talking to him before, but now you're really interested because now it seems like there's something being hidden. So whenever a client doesn't let you get the information, you take that much more seriously. If for no other reason than if they don't want you to get this evidence, you have to wonder, why don't they want me to get this evidence, whatever it is. So I got a weird thing, my click on something. Okay, so there's not enough evidence available. Now, it's unknown if a misstatement exists. The financial statements may be absolutely spot on, but you don't know. You can't get the evidence to one way or another. So a disclaimer is when you have no opinion. You can't get the dollar amounts. If they do list the dollar amounts, they'll say something along the lines of, we couldn't verify, the accounts receivable, the sales, the ending inventory, or whatever it is. But again, it'll just mean that we can't verify it. Doesn't mean it doesn't exist, doesn't mean that it's not absolutely correct. It could be, but we just can't get evidence one way or another about it. Okay. So let's go to some of the multiple choice. How many are there? This is the end of it? Hey, we're almost at the end of this thing. Okay. So number 8, the auditors were unable to verify significant investments made by the client. Which of the following audit reports would be appropriate for this scenario?
Disclaimer of opinion.
Yeah, could be disclaimer of opinion here. That if they can't get, excuse me. That's what I would. If they can't get the evidence they need, they can't verify these investments. They can't make an opinion. Doesn't mean they don't exist. Doesn't mean they're wrong. It just means they can't verify it. The auditor determined that cash, inventory, and revenues were all materially misstated. Which audit report would be appropriate?
Modified adverse report.
Yep. Yeah, if it leaks into more than one account, it's going to be an adverse. Auditor determined that cash, inventory, and revenues were all immaterially misstated. Which audit report would be appropriate for this scenario?
Unqualified.
Yep. Yeah, and if it's all immaterial, it's you just give them unmodified. Auditors were unable to verify a material amount of offsite inventory in the client's books. None of the other accounts were materially misstated. Which audit report would be appropriate in this scenario? I'll give you a hint. There's 2.
B and D.
Yes and yes. It is possible that, first of all, if you can't verify it in this material, you could give a disclaimer of opinion. But you also might give a modified qualified opinion. You say, well, why would you do that? A disclaimer says nothing. Here's nothing. A qualified opinion says, look, we can't verify this inventory, but everything else here is fine. So that will help the client. They can at least take this qualified opinion to the bank and say, well, they couldn't get the information on this inventory for a reason. But all the rest of the stuff, the cash is okay, the sales were okay, everything else was okay. So it is possible that even though you have what they call a scope limitation, that you can't find information, that you could still give them a qualified report because it does give some information on it. And you'll list in there that, we can't verify this material amount of inventory, but that the other stuff is okay. So that's one of the weird ones that you can actually give. There's two opinions available. You could give them a disclaimer saying, look, we don't know how big this thing is. We're giving you a disclaimer, which is nothing. But if you can, you would always try to give them something of value, and that would be a qualified opinion. Even though it's not a clean opinion, it still can help them in getting financing or investors or whatever. Why are qualified and adverse opinions rare?
B.
Yep. It doesn't do a company any good to have those. So generally speaking, and that's the whole idea behind it, is that you would, that you would be able to say to them, look, it's going to be in the audit report anyways. We don't want to make those changes. We think that they are, we think that our sales should be this amount, whether they are. Say, look, it's not going to do any good. It's going to be in the audit report. They're going to read the audit report, and then it's going to be you're going to look really bad because the financial statements are going to look like they're fraudulent, and that it'll make an impact on yourself. So there really is no advantage to a company not making those changes. So they are fairly rare. They're virtually non-existent for issuers, because if an issuer were to get an adverse opinion, even a qualified opinion, the SEC would stop trading on their stocks immediately. They would, it'd be horrible. So, but even in the private practice, there really isn't an advantage to, them getting an adverse opinion. It doesn't do them any good to get an adverse opinion or even a qualified if they can avoid it. Okay, well, hey, we finished it. Yay. So this is what we'll turn in for this week. Let me make sure I have it in the assignments. I think I put it in. Yeah, it's gonna be due by next week. Due by next Friday. So we just, but yeah, so you just turn this in. Next week, just to let you know. What am I doing? Next week, we will have, I'm going to give you some CPA questions or things that are similar to CPA questions about chapters 1 and 2, just to kind of get us used to getting these questions. Their CPA questions are worded different than most things you'll run into. So we're going to try to get it, as much exposure to that kind of stuff as you can. So next week we'll have the multiple choice questions over chapters 1 and 2, and I'll let you know it's going to be on the test, and we'll have a test over chapter 1 and 2. I'm not going to send it out until next week. So next week, chapters 1 and 2, we'll do the multiple choice questions. We'll probably start chapter 3, which I'll send you a handout. You don't have to worry about that right now. I'll send you a handout about that next week, and we'll probably continue with the classical sampling also next week. Okay, any questions? So the only thing you turn in this week, the only thing is, no, not that, not that either. Okay, I wanted to show you guys things you don't have to turn. Oh, here we go. So the only thing you have to turn in is the one thing we just finished, the chapter 1 and 2 handout. Turn that in, and that's it for this week. Any questions? And so next week we'll do the multiple choice questions. We'll go through those, and then you can also go to class and get extra credit points based on how well you do on those multiple choice questions. And so next week will be the first time, the first exam will be sent out next week, chapters 1 and 2. And we'll probably start on chapter 3 and do some of the classical sampling. Any questions? Okay, well, have a good evening and have a good weekend. And I will see you guys in a week's time.
Thank you.
Thank you, Professor. I have a question actually. My printer's not exactly working the best. A lot of the color questions that you had, basically they come out like kind of super faded. Can I just handwrite them in and just circle the answers? Would that work?
Yes, and you can also just, you don't even have to do that though if you want to. If you just highlight the whole thing and change it to, to dark, and then
I'll try that, because as of right now, since it's on PDF, I have a Mac, and it really isn't letting. Right.
Well,
it's not letting me make any changes to it, so I'm like, shit.
Yeah, I tell you what, I'll stop doing that. I'll stop putting them in black and white. I might change them on my screen, but from now on, I'll put them all in black and white.
That would be great. Thank you. So I'll just handwrite them in, and I'll just send them I'll have them saved and send them back this time. And then next time, just if you could make them all in color, that would black and white. That'd be great.
I'll put them all in black and white. Yeah, and but even if they're faded, however you send them to me is fine. If you don't just write them on notebook paper or whatever, that's fine too. I mean,
that would be awesome. Thank you. The other question actually goes to what we were talking about tonight with what was it called? The basic classical sampling.
Yeah.
We saw that 3 of the 5 accounts receivable that were chosen were incorrect, and you could say that's material saying that it's off by a couple $1,000.
Well, and you're absolutely right. Now you got to realize that I kind of rigged those so that they would, I didn't want to have to take a sample of 50 items or something like that. But yeah, if you were to go through those, and you say, okay, if 40% of them are misstated, why are we even doing this? But yeah, that was just me kind of making it a little bit more
Intentional.
exactly. Giving people something to look at rather than because if you look at these, there's two of them here that are misstated. I don't know, but anyway, if there's two of them that are misstated, that's 40% of the things you pull up are misstated.
Mhm.
Yeah.
Well, right. It's just such a small sample size. I get it. But I was referring to as well the fact that, hey, this is, off by a couple $1,000s. Is that not a material? Is that not a material amount?
Well, truthfully, like for instance, like these two that are like this one's off by 1,000, right?
Yeah.
And this one up here is off by 400.
Sure.
Now you may even if you determine that this was not material, that the projected amounts weren't material down here, you may very well give that to the client and say, look, you might want to adjust your books at least for those two that we found, because your books are off by those two. But yeah, if you were really doing an audit and if 40% of the stuff was off, you would say there's definitely a problem. Somewhere there's a problem if 40% of your sample is misstated. Even if it's not materially misstated, there's still a problem with something.
Approximately, what would you say would be a material difference then? Because like we came up with that's $1,400 out of 200. But
well, it really depends on what you're looking at, and we'll get into this in chapter 6 a little bit, and that is materiality based on a percentage, usually of, could be income, could be revenues, or whatever it is. And for smaller companies, we give a larger percentage to them. Why? Okay, well, if the books are misstated by $10,000, no one's probably going to sue you over that. It costs more than $10,000 for the lawsuit. So even though it might be a kind of high percentage relative to what the actual dollars are, it might be fairly small. Take on the other hand, though, you take a large company, maybe materiality for them would be $260 million based on their sales.
sure.
Well, you don't want to go into court and say, hey, we missed $260 million worth of sales. So a lot of times you'll actually hold them to a higher standard. Instead of giving them 3%, maybe you only give them 1%, because you don't want to go into court and say, look, we missed hundreds of millions of dollars of error just because the numbers are so big.
Right.
So it is one of those things that a smaller company, you give them a larger percentage that they can be off by.
Okay.
Because they're smaller dollar amounts. But when you get the big companies, the dollars just become huge. And again, people will sue you for $260 million.
Gotcha.
They will. 10,000, probably not. So yeah, there is that kind of sliding scale that the smaller companies get a bigger percentage that they can be off by more than the larger ones.
Gotcha. Thank you so much, Professor.
Anytime.
Thank you. Bye.